Gary Broad from Deep Knowledge Investing. I'm coming to you from Marrakesh, Morocco. And at Deep Knowledge Investing, we work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I am here with our host, Rob Ferry, and he's the CEO and founder of Flying V, our digital marketing partner. Rob, so good to have you back in the hosting seat after Mark Rosanna from C6 Capital did a great job filling in for you last week, but always good to see you. How you doing?
Doing great, Gary. Yeah, how's Morocco? I hope it's going well over there on that side of the world. And yeah, thanks to Mark for filling in for me last week. Really appreciate that, Mark. That was another great episode, and we've got another one coming to you, opening bell edition. I know we're about 45 minutes after the opening bell here in the markets. Things are already ripping and roaring. I'm excited for this episode. I know, Gary, you are as well. We're calling it the demerger issue. So we've got all sorts of stuff going on here. We're talking Google. We've got Keystone Pipeline, green energy conversation, Warren Buffett, Kraft, Pepsi, Elliott Management. And then to close out, we get into our educational section where we're going to talk about market cap, enterprise value, etc. Everything you need to know there. Gary, so let's get into it. Thing number one, we've got a theme going throughout this 5 things in terms of divestitures and things going on with some of these big names. The first one, Google. Thing number one, Gary, Google avoids forced Chrome breakup in antitrust ruling. Again, Chrome being their internet browser. Gary, tell us about this ruling.
All right, Rob. So Google has been in antitrust court for a very long time. The judge in this case, Judge Amit Mehta, was appointed to his position by President Obama. And even though he determined that Google had a monopoly in the search, is Google is paying Apple, I believe, $20 billion a year to be Apple's default search engine choice. And somehow Judge Mehta, despite affirming Google's monopoly in search services, said, yeah, but you can keep paying Apple $20 billion to maintain your position, which I have no idea how we managed to do that. And the reason this matters, Rob, is because the defaults are important. This is the issue that got Microsoft in trouble with a antitrust official back in the 90s. Basically, what happened was their search engine and Internet Explorer with every version of Windows. And people like the defaults. They just, oh, this is what I have, and they go with it. It's not that common for people to start searching for their preferred providers, and down huge benefit to the default provider. The ruling by Judge Mehta does impose some minor behavioral remedies. I'm going to read this off here. Google has to cease distribution agreements, although they can still pay Apple $20 billion a year. They have to share certain search index data with qualified competitors, including emerging AI-backed search platforms such as Perplexity, OpenAI, and DuckDuckGo. Alphabet's stock was up over 8% following the ruling. Apple's stock was up a few percent. And I think part of the big deal on the ruling was a recognition that generative AI is reshaping some of the tiny bit of market share in search. And so that's dynamics. And basically they're taking where the judge came out.
Yeah, Gary, I think you nailed it just in terms of the shift of the search market, right? And especially the ruling where you're talking about these minor behavioral remedies in terms of what they need to do or not do with, your ChatGPT's open AIs. This is a lane we play in a ton, right? And clients a lot of times ask us, hey, Google, yes, what about Bing? And actually, Bing does have a very strong market. It's just with a particular demographic with those that buy PCs, right? Because same thing that you said, instead of it being a default Chrome browser like you have on Apple. Now all of a sudden you've got default Bing, and it tends to be an older demographic. So for targeting guys like my dad, we might go after Bing because that's what they tend to use. So Gary, it's been crazy too to see the uptick of just traffic that we've sourced as well from these AI, ChatGPT bots, whatever you want to call them, generative AI. We're calling it generative engine optimization, right? To where Google is losing that search volume, right? That search share, all of those things. So I guess, this is obviously a win for Google, I would say, for sure. But I got to imagine antitrust experts probably a little bit unhappy with Judge Meta because, I think there was a little slap on the wrist in terms of these minor behavioral remedies, but more or less they can still do what they do. And you're exactly right, that embedding of Google. And if they can catch up in this AI arms race, which I have no doubt Google would, that puts them in a great position.
Yeah, Russ. So let's actually unravel really simply both sides of this. And there's no question Google executives were celebrating this decision. They were openly thrilled. So the judge is right on the idea that AI is taking some share. And if you think about it, go back a few years or even now, if you have a search, you put it in the search bar and Google will say, okay, here are our sponsored links. And then here are a bunch of other links that you can click on them and go and look for your answer. But now most of the time when I have a question, I just go to one of the AI accelerators. I may go to ChatGPT, or I use I use Grok on X a lot, and you just ask the question and it returns an answer instead of here are a bunch of links, go look for the answer. Then I want to read a whole bunch of stuff. But sometimes I just want a quick answer to something. And, these AI bots are definitely taking some share. That said, Google's market share is still well over 90%, and they have a gigantic war chest of tens of billions of dollars to buy, if not exclusive, certainly default status at places like Apple and others. And so the reason why antitrust experts were livid about the solution is because once the judge makes a determination that Google has an illegal monopoly, he's required to both force them to correct the monopoly and to give up any illegal profits. That didn't happen, right? And they've got to do some information sharing, but the fact is he left in place Google's ability to maintain both the illegal monopoly and the profits from it. So, look, I'm hoping that by talking about this, our channel on YouTube doesn't get completely nuked. But, this is why Google was thrilled with the decision and why antitrust experts were pretty upset about it. And now you understand both sides of it. I'm curious to know, if you're watching this, what are you using for search right now? Are you using Google? Are you using DuckDuckGo? Are you using a different Bing? Maybe you're older, like Rob said. Are you using ChatGPT or Grok? And then, separately from this, I'm interested in your opinion on it. What do you think? Did the judge make the right decision? Does Google have a monopoly? Should they have been forced to divest Chrome? And it's something we talked about on a prior version, a prior edition of the 5 Things, where, somebody did make a bid. We actually, 2 companies made a bid for Chrome and they said, hey, we'll buy it. And so I'm sure they were pretty disappointed as well that Google does not have to divest it.
Yeah, I'd love to hear that as well from our audience. What are you using? How are you using these tools? We're finding that leads that do come from ChatGPT, like we have phone calls from clients saying, hey, found you on ChatGPT, right? They're so high intent. So like these results that they're getting to, but the difference is that, like you said, Gary, they're getting the information right, or they're reading a lot more throughout what we're calling multi-turn conversations, right? So by the end of it, they're more confident in that result that it does spit out when you finally say, okay, I've determined A, B, C, D, E, whatever your criteria is. Now tell me what my best option is, right? So it's been very, very interesting, fascinating, because then we're weighing like, okay, what does our investment look like in traditional search just from an ROI standpoint if we're getting just higher qualified, ready to close hot leads coming from ChatGPT. So definitely something we'll be keeping eyes on, and hopefully we can sync back on that in later episodes and editions. Gary, moving to thing number 2, we're now talking green energy, and we're bringing into the fold revolution wind. Thing number 2, Gary, offshore wind faces trouble with revolution wind suspension. Okay, whoever wrote that headline, I'm going to have a talking to.
We're going to credit the interns on this one. And I really have to credit the interns. They found a government agency I did not know existed. Raise your hand if you are familiar with the fact that the United States has a Bureau of Ocean Energy Management.
Not surprised.
We have such a thing.
Yeah,
right? And
makes sense.
Right. And so, for the people who say, the government is too big, I think when you have a Bureau of Ocean Energy Management, the BOEM, apparently that may tell you something. Anyway, at roughly 80% completion, the BOEM issued a halt directive to a company called Revolution Wind. They were doing windmill installation. Mm-hmm. And what the Bureau of Ocean Energy Management cited was radar interference concerns with the project. Ørsted was the project's developer. They complied. They paused installation. The project was supposed to be 704 megawatts and was intended to deliver electricity to 350,000 homes. But I would point out that that's only when the wind is blowing, right? So, if you're going to use wind power, just a reminder, a very expensive, environmentally unfriendly battery backup, or you're going to need some sort of coal or natural gas or instant on kind of power for that. The move to suspend does affirm President Trump's continued opposition to unreliable sources of power like wind, support of energy independence through oil and gas. It's also worth pointing out that a lot of the wind farms are largely built by European developers. That reinforces President Trump's skepticism of foreign influence, not interference, influence in U.S. infrastructure. I was thinking about China there. China makes most of our solar panels. There is reason to be concerned about that. I don't think the Europeans are putting harmful malware in the, our wind equipment. So pointing out here that while the offshore wind farms do have clear benefits, they cost more than onshore wind. They cost more than solar. You need a ton of oil to make the blades for them. You need an enormous amount of cooling to drive these deep into the ground, even if it's underwater. And they also serve basically as bird blenders and kill a lot of wildlife in the area. So, there are reasons why people were concerned about it, but, I think a key part of it is really the reliability and of these kinds of installations. Also, I don't know if this is true or not, Rob, but I've read that there have been issues with the reliability of wind power, not just it only works when the wind is blowing, but something about the air and the salt water tend to corrode these things, and the useful life is less than a lot of people expect. If you're an expert in this stuff, put it in the comments. I'm curious to know what you think about the useful life of these things.
Yeah, agree, definitely, because I know obviously, Gary, we're very bullish on nuclear, right? Especially with AI and tech and the use of that infrastructure, right? And we're just not seeing the picture here from the wind side. But Gary, let's put the energy aside, because if you look at Ørsted's stock price, right? I mean, it had a run from about 250 up to, I think it was 325. And then there was a catalyst where they failed to sell the stake in Sunrise Wind. That took the stock price all the way down to $200, right around there. Wind project halted, another dip. Now I think it's trading sub 200. I mean, what really is the business lesson here, or what do you take away from this from an investment angle?
Rob, for me, a lot of times people will suggest ideas to me, and I always say I don't like binary situations. I don't like a situation where your investment success is going to be determined by a ruling from a judge or a ruling from a regulatory agency, because they don't do what you hope they're going to do. It's not going to happen on your time frame. And you wait, and there's a day, and like you pointed out, the Orsted stock price went from 325 to around 200 in just a matter of weeks. Sorry, a month. That's pretty rough to get blown up like that. And so, I think it's dangerous to be investing in a company with a business model that's too heavily reliant on, one, government subsidies as opposed to consumer demand, and two, where you require a government regulatory agency to approve something or not approve it. Right now, Rob, you have a lot of green energy advocates who are pretty angry about this decision and saying, how could this happen? Well, I'll tell you how it could happen. The same way the Keystone Pipeline got stopped by the Biden administration, right? Like, this is what happens. Governments make decisions. And the Keystone Pipeline, they've been building that thing for years and years and years. And all of a sudden, the White House says, nope, it gets stopped. Yeah. And, people are saying, my God, these guys were 80% done with this. It got stopped. Yeah, this is exactly what happens. And so I don't want to get into the politics, team red, team blue, green energy, carbon energy. I don't want to get into all that. My position on this is, don't be in the path of government agencies, and don't be in multi-year projects where a government agency or the White House can say, yeah, we're not going to allow this. In the end, here's where I'm invested on this. The US needs more electrical generation. The political will to build more carbon-based ones doesn't exist. The current administration's not thrilled with wind and solar. So where does that leave us, Rob? Nuclear.
Yep.
Right? If you think you own enough uranium, you probably don't.
Great stuff. Yeah. Gary's been saying it for years and years, hammering it into my head. No brainer. Just go look at the numbers. Bottom line. So, Gary, moving on to thing number 3. This one's exciting. We got Warren Buffett. We don't talk about him very often. So anytime, obviously, a famous investor, big name, and he's not happy. So even better. We're talking about Kraft Heinz. Gary, thing number 3, Kraft Heinz to spin off into 2 focused big businesses. What do those look like? We'll be talking about Warren here in a minute as well.
Rob, I got to tell you, the interns went with the basic Kraft Heinz operating margin graph, right? They went with finance. Do you remember a couple of Olympics ago, Michaela Maroney, that that she's not amused meme where she just looked annoyed?
Yes.
We should have had like an AI version of that, but with Warren Buffett's face, right?
Well, we
looking displeased.
We could still do it. So if Cashin's listening, let's fire that up.
Yeah, or get Nazim to use ChatGPT and say we need a mashup of Warren Buffett's face and Michaela Maroney's not amused. We're gonna have to work on it. All right, here's the news. Kraft Heinz is spinning off into 2 focused businesses, right? So they announced a tax-free spinoff into 2 publicly traded. It happened by late 2026. So about a year from now, you're going to have 2 businesses. By the way, you're going to love the names. You ready for the sexy names here? There's going to be a spread-based business, right? So brands like Heinz ketchup, all of the spreads, things, ketchup, all that stuff. Okay, ready? That's going to be called Global Taste Elevation Corporation. Pretty hot, right?
Well, I mean,
don't answer.
Does
the
that
food business?
Does that insinuate that we have bad taste? Does the globe have bad taste if it's Global Taste Elevation? Love that name.
Yes, exactly. Yeah, some consulting firm made millions of dollars on that. So you know what, Rob? Somewhere there is a marketing firm getting paid more than Flying V that came up with Global Taste Elevation Corporation.
Oh, Harry, you're getting me in way too much trouble here.
Rob, all I have to say is if you ever get hired by Kraft Heinz, just call me. I'll call the interns. I guarantee we can come up with something better than that. But wait, we're not done. There's going to be a food business. That business is going to feature food things like Oscar Mayer, Lunchables, Kraft Singles. Ready? They're going to call that This is very exciting. North American Grocery Corporation.
Got it. Nice. Well done, marketing team.
Yeah, exactly. This to me, it's almost like they're saying, please treat us like generic food. Here's generic spread. Here's generic food. Yeah. You're a branded company. Come up with a brand.
Yeah. Wow. Yeah. Interesting.
All right. And the move here is a strategic pivot. It's aimed at reducing complexity, each entity to focus on specific market dynamics, global condiments, staple grocery products. Investor reception has been tepid. Warren Buffett is not happy. He warned may not fix structural issues. In fairness to the company, though, Kraft Heinz merged about a decade ago. And right after the merger, they had operating margins in excess of 20%. Now I'm checking the graph that the interns did. Good job, guys. And their margins over the last few years have been like in the 8 to 12% range. They did have a good 2023, around 18%. 2024, not so good, mid-single digits. So basically, the whole point of the merger was the Kraft Heinz merger was you were supposed to get these operating synergies and better margins. And instead, their margins went down. So, they're basically saying, let's throw in the towel and, split the companies.
Gary, with management, I mean, why would they want to do it that way, right? Obviously, when it seems like you've got some displeasure coming back from the ranks, and especially at the top of those ranks.
All right. So again, let's take a look at it from both sides. From the point of view of management, they're saying, hey, we did this merger. The idea was to get better margins. It didn't work. And so we're going to split the company up into these two pieces again. Basically give each side a professional management team that's just focused on doing what they do well. And you could say, hey, wait, is selling ketchup really that different from selling Oscar Mayer? And the answer is, yeah, it's a little bit different. Theoretically, you could have the same people working on it, but this is the idea on it. The reason Warren Buffett isn't happy is because his point is, guys, you did this merger a decade ago in order to benefit from this stuff. Pull it together. Don't do a divestiture where you're going to have, two marketing teams, two management teams, two sets of public company costs, two audits. Basically, their expenses are going to go up as a result. I would mention on this is, these brands, it's the United States. A lot of people are moving these kinds of products, right? And you might say, okay, well, wait, Oscar Mayer, Lunchables, Kraft Singles, but the current administration and the Secretary Kennedy at Health and Human Services is really trying to push Americans away from this kind of ultra processed food. And let me ask you, are you eating more of the stuff? The people are they eating more of this kind of stuff or less?
Yeah, definitely. I know in our household less. Wife doesn't even, she won't consider it, right? Definitely looking for the alternative option, right? A lot of the processed stuff, and I think that's just health tech, right? I mean, it just continues to be the direction that most everything starts to move. So, Gary, moving on. This is the demerger issue of this week's 5 Things to Know. Please head to our website. I know we're on live right now, deepknowledgeinvesting.com. You can sign up for a free subscription. You'll get delivered this written version of the 5 things each and every week. We'll also be live hosting this show, as well as distributing through all of our online social media platforms. And then we have a premium subscription, $100 a month, gets you access to all premium gated content, whole access to the site, current recommendations, buys, sells, etc. The whole 9 yards there. And if you're just listening in, thanks so much. Really appreciate you spending your valuable time with us. Having so much fun, Gary. I forgot to even do the promo. And we don't even run ads. No ads. Just one ad, I guess. I guess that was our ad. So, but anyways, Gary, thing number 4, we're talking Elliott Investment Management. They made a big push into Pepsi. Thing number 4, Gary, Elliott Investment Management's $4 billion stake in Pepsi. What do we need to know?
Yeah, so Elliott Investment Management is run by Paul Singer. Super interesting guy, somebody I've met before, and I have a ton of respect for him. They announced a $4 billion stake in Pepsi. And Elliott is an activist fund, and they went activist right away. So they now own almost 2% of Pepsi shares. Elliott highlighted that Pepsi's beverage division, which includes Pepsi, Gatorade, Mountain Dew, they've lost market share for more than a decade. They've consistently underperformed competitors such as Coca-Cola and Dr. Pepper. I'll also point out, Rob, there are tons of new drinks that have grabbed enormous amounts of market share, even in the water business, Liquid Death. They made a ton of money selling at things like music festivals and grabbing attention there. You certainly see it like in New York bars. Not that I've been.
Yeah, I keep eyes on.
What's that?
I keep eyes on the CPG space as well. And so you've had like these alternative kind of healthy sodas, right? I don't know about that. So I'm sure, but Poppy, Olipop are some names, right? Poppy was actually acquired by Pepsi, right? So that was a push for them to move into that market, right? To where, okay, here are some of these alternatives, but then it upsets the apple cart with all of the loyal followers when you have a buyout like that happen, right? Same thing happened on the pasta sauce side. We're involved in that area too. And Campbell's bought Rouse, right? And so now you've got that whole dynamic. But yeah, sorry, how to interject there, because you're exactly right, Gary. There are just so many alternative options, and that's just in the soda category, right? Talk about everything else as a beverage unit.
Yeah, by the way, we'll come back to Pepsi in 1 second. I read a really good story when Campbell's was negotiating to buy Rouse. Or is it? I think it may be. I'm not sure. Anyway, they said, "Hey, listen, we have this special recipe, and we're really worried you're going to change the recipe, and we don't want that." And Campbell's, to their credit, said, "We've had the same recipe for tomato soup for 100 years. We are the kings of not changing recipes." And that was what sealed the deal, right? They're like, this is what we do. We've had the same chicken noodle soup recipe for decades.
Yeah.
So good for Campbell's on that one. I also think Pepsi is big. Let's go back to Pepsi. I think they've been losing as well to like energy drinks, things like Red Bull. It's been a problem for them. And Pepsi's market value is down more than 25% since its May high. That's a big drop. So, Paul Singer and Elliott Management, they're reviewing options for Pepsi's snack unit, right? That's Lay's. And basically, what they want to do, by they, I mean Elliott, is the opposite of what for Kraft Heinz. That Elliott is actually suggesting that Pepsi should re-franchise bottling operations, mirrors Coca-Cola's model, so giving up some control and have outside franchisees. And then look at streamlining the product portfolio by cutting underperforming food and beverage. The whole idea of Pepsi and Lay's is, hey, they sell to the same place, right? You just need a set of trucks driving to every 7-Eleven and convenience stores and grocery stores. Basically, any place where you would sell Frito-Lay's, you would be selling Pepsi, Gatorade, Mountain Dew, stuff like that. But it hasn't been helping. And so Elliott Management is saying, let's start taking a look at everything and start divesting the stuff that's not working, selling things. So really interesting that Paul Singer in this particular situation, again, another consumer products company, is going the exact opposite direction that Warren Buffett wants to see Kraft Heinz go.
Yeah, very interesting. I mean, Gary, and I think we alluded to it, but I mean, doesn't this just speak to the power, brand power, pricing? Obviously, we spoke about changing tastes that Americans are having, just different priorities, what we're prioritizing as a society. I mean, yeah, I think that just paints a very, very, very clear picture there.
Yeah, it's really interesting what's happening, Rob. First of all, we talked about this in Larry Kennedy at Kraft Heinz. Secretary is really trying to push Americans toward eating more healthy. In the case of Kraft Heinz, saying, hey, enough with the ultra processed foods. Let's eat more natural foods, more healthy foods. I'm with him on that. When it comes to stuff like this, to say, drink less water full of high fructose corn syrup. I mean, listen, I'm not qualified to give medical advice. I'm not a doctor. That's not what we do at Deep Knowledge Investing, but I'm comfortable saying that we should all be drinking less water full of high fructose corn syrup, right? I mean, that's just general health stuff. So I think Americans are becoming more health conscious, and things like, Pepsi, Gatorade, Mountain Dew, Frito Lay's. There's a reason that those brands aren't doing as well as they had in the past. Is those companies a lot. The other thing, and I think they've hit, they're saying, you know what, enough. Either I don't need this, I'm just going to eat healthier. Or alternatively, I think a lot of people have realized for stuff like this, the store brands are often just as good. And that there are cheaper options. And it's not, this is exact comparison, but I know, like when I'm at home in Connecticut and I go to Costco there, I buy a lot of their Kirkland brand stuff, right? Instead of the branded stuff. It's cheaper, and I think the quality is at least as good.
Yeah, I think you nailed it, Gary, and definitely going to be interesting, and you're seeing it play out in real time here with Pepsi. Moving on to thing number 5, and apologies, Gary's traveling. He's in Morocco. So I know there's a little lag back and forth, but appreciate you hanging on there with us. Part of bringing unique perspective, doing this show all over the globe, really, and getting a real macro view on what's happening to bring you everything that you need to know. Again, head over to our website, deepknowledgeinvesting.com. Use the Ask Gary feature. You could submit a question in for the show. We might cover that in one of our topics. Would love to just communicate with those of you that are out there and listening, and really appreciate and thank you for your support. Moving on, final thing, thing number 5, educational topic, market cap versus enterprise value. Gary, let's start. Give us the definition, Gary, of market cap and how it's calculated, basically, because I think it's the same thing.
All right. So, right. Yeah. So a lot of times people get confused with the terminology. This is to calculate a company's market capitalization, which is just the value of all the stock outstanding, right? The stock market value. We're going to take the fully diluted number of shares and multiply it by the stock price. It really is that simple. And when you multiply the number of shares by the stock price, you have the value that the stock market is putting on all of the company stock. That's it. It really is that simple.
And then Gary, moving over to enterprise value. What is it? How's it calculated for our guests out there? Just to really give them a simple explanation of both of these topics. Okay, looks like we might.
Sure. So enterprise value is often referred to as aggregate value, and it for the amount of.
Keep going, Gary.
So hang on. It is simple. We'll just do that segment again. For those of you listening live, thanks for being patient. We appreciate it. So enterprise value is often referred to as aggregate value. And all we're doing there is we are taking the market cap of the company and adjusting for the debt. So you take the market cap and add the debt and subtract any cash, and that gives you your enterprise value or aggregate value, which is basically the full value of the company adjusting for the balance sheet, right? So shares outstanding times your market cap, and then add the debt, subtract the cash, and now you have enterprise value or aggregate value.
And then Gary, just in terms of these topics, when do you use market cap? When are you using enterprise value?
So you would use the enterprise value to figure out your multiple on everything on the income statement before you subtract interest. Now, I know that sounds complicated, but we're going to make it really simple. So before you subtract interest, you would have things like revenue, EBITDA, which stands for earnings before interest taxation, EBIT or operating income, or earnings before interest and tax. And so all of those, because we haven't subtracted interest, we would look at aggregate value or enterprise value and use that to calculate that multiple, right? You would simply say your enterprise value divided by revenue, enterprise value divided by EBITDA, things like that. Now, when we get down below that and interest, you would use the equity value or market cap to multiple that you're paying for earnings. And we talked about this last week, right? That's your PE, your price per share divided by your earnings per share, right? It's the exact same thing as saying, give me your market cap divided by your net income. So it's the same calculation. So if you haven't subtracted interest, use enterprise value, otherwise known as aggregate value. If you have subtracted interest, then you got market cap. Rob, you're muted. All right, for everyone listening to this live, we apologize. And Nazim, we're gonna have to fix this. Rob, you've been muted.
Yes. Okay. So that's not only internet issues, but dumb issues. I was saying it was a beautiful thing too. I was just telling everyone, hey, I hope you have a beautiful Monday, and we really enjoy bringing this show to you. Gary, thanks for doing this with me. Head over to Deep Knowledge Investing, yada yada yada. Gary, final thoughts. Turning it over to you.
All right. Thank you, Rob said. I am in the old town of Marrakesh, Morocco. It is a fascinating, exotic, interesting place, but the internet connection is not the most technical, but I'm sure Nazim will fix that and edit. Thanks, Nazim. Rob, also want to thank you. Always, it was great having Mark Rosano from C6 Capital fill the hosting chair. Worth pointing out to everyone, Rob and his firm at Flying V have just poured enormous amounts of time, attention, effort, and care.
Okay, now I think we lost
Deep Knowledge Investing. If your marketing team cares enough to be doing this with me, all right.
All right, Gary, we're gonna call it a wrap. We got through a lot.
Saying nice things about.
I don't even know what's going on at this point, but hey, thanks everybody for watching. We'll see you next